Hey everyone, and welcome back to the deep dive. Today we're going to be tackling something pretty big. We've gotten a ton of requests to cover investing in India,
Yeah, lots of interest in that.
and a lot of you sent in this guide
It's a good one.
published jointly by SEBI.
The Securities and Exchange Board of India?
Right, and all the major stock exchanges and depositories in India, so it's like the official lowdown on how this whole thing works.
Exactly.
So we figured, why not do a deep dive, unpack this thing, see what gems we can uncover, because honestly, there's a lot to unpack here.
Oh, yeah.
We're talking regulations, different types of securities you can invest in, the whole process of actually opening an account, even tips on how to avoid, like, the classic newbie mistakes.
Avoiding those pitfalls.
Right. So if you're even remotely interested in investing in India, or maybe you're already dabbling but want to level up your knowledge, this deep dive is for you. So where do we even begin with something this massive?
Well, I think a good place to start is with the lay of the land, the regulatory landscape.
Okay, so like the rules of the game.
Exactly. Who's in charge? What are the laws? All that good stuff.
Right, because in any market, you kind of want to know, like, who's making sure things are fair.
Right. Who's keeping everyone honest?
Exactly. So in India, the big kahuna is SEBI, right? The Securities and Exchange Board of India.
Right. They're kind of like the referee.
The referee. I like that analogy.
Yeah, they're there to ensure fair play, transparency, protect investors like you and me.
From, like, scams and shady dealings.
Exactly. Those malpractices that can happen anywhere, unfortunately.
Yeah, no market's perfect.
No market is perfect, but, at least we have SEBI.
Right. Okay, so we got a referee in place, but how do they actually make sure everything runs smoothly? Like, what tools do they have?
Well, the foundation is the law. Right. And in India, you've got four main laws that govern the securities market. Think of them as like the rule book.
Okay, the rule book, what are those for?
So first you have the SEBI Act of 1992.
1992, okay.
That's like the cornerstone. It basically gives SEBI all the power to oversee everything, make rules, enforce those rules, you name it.
So it's like their mandate.
Exactly, their mandate. Then you have the Companies Act of 2013.
Okay.
Now, this one focuses on companies themselves, how they issue securities, how they manage those securities, making sure they're transparent with investors, all of that.
Right, because companies can't just, like, do whatever they want.
Exactly. They need to play by the rules. Then we have the Securities Contracts Regulation Act of 1956.
56? Wow, that's an old one.
Yeah, but it's still very much in effect. And this one is all about the actual trading of securities. So, setting rules for how buying and selling happens on stock exchanges, making sure everything's above board, no manipulation, that kind of thing.
Okay, so basically making sure no one's, like, rigging the game.
Exactly. And finally, we have the Depositories Act of 1996.
96, okay.
This one ensures your investments are held safely in electronic form. This is where DMAT accounts come in. They're like your digital vault for holding shares and other securities.
Ugh, DMAT accounts. I've heard that term before.
Right. They're essential in today's market.
Okay, so we got the SEBI Act as the foundation, Companies Act keeping companies in check, Securities Contracts Regulation Act, making sure the trading's fair, and then the Depositories Act for, like, safekeeping.
You got it. It's like building a house. You need all these pieces for it to be, solid and secure.
Love that analogy. Okay, so now that we know the rules of the game, what are we actually playing with? Let's talk about these securities.
Right. The things we're actually investing in.
Right, because securities, that can be a bit of a vague term.
Yeah, it's a broad term, but basically any tradable financial asset that holds value. And this guide covers four main types that are big in India.
Okay, hit me with them.
Okay. First up, the most well-known, equity shares.
Equity shares, those are just like stocks, right?
Yeah, stocks. Think of it as owning a tiny piece of a company.
So, like, if the company does well, my slice of the pie gets bigger too.
Exactly. You get to share in the profits. Sometimes you even get voting rights on big company decisions.
Wow, so you're not just an investor, you're a part owner.
In a way, yeah.
That's cool.
But remember, there are different kinds of equity shares too, like common stock, preferred stock, even some hybrid instruments.
Oh, I didn't realize it was that nuanced.
Oh, yeah. Each type has its own set of rights and privileges.
Yeah.
So understanding those is key if you want to make smart investment choices.
Got it. Okay, so that's equity shares. What about, like, the non-ownership options?
Right. So then you have debt securities. Think of these as loans that you're giving to companies or even institutions.
Okay, so I'm lending them money.
Exactly. And in return, you get regular interest payments, and eventually they pay you back your principal, the original amount you lent.
Right, so it's more about steady income rather than, like, potential high growth.
Generally, yes. Bonds and debentures, those are the most common types of debt securities, and they're usually seen as less risky than stocks.
Okay, lower risk, steady income. Got it. What else is there?
Now we get into the more uh, complex stuff.
To me.
Derivatives.
Derivatives. Those are the ones I always hear about but never fully understand.
Yeah, they can be a little tricky. Basically, they're financial instruments that get their value from some other asset. A stock, a commodity, something like that.
So, like, their value is, what, derived from something else?
Exactly. It's like, imagine betting on whether the price of something will go up or down.
Oh, so it's like a financial prediction game?
Kinda. Futures and options, those are the most common types. They can be super profitable, but also way riskier than just buying stocks or bonds directly.
Right, because you're not just betting on the asset itself, you're betting on, like, how its price will move.
Exactly. It's leveraged.
Okay, so stocks, bonds, and the kind of wild world of derivatives. What's the fourth type?
Okay, this one's a favorite for many. Mutual funds.
Ah, mutual funds. I've definitely heard of these.
Right. They're a great option if you want diversification.
Diversification meaning?
Meaning, not putting all your eggs in one basket. Spreading your investments across different things to reduce risk.
Makes sense.
So, with mutual funds, your money is pooled with other investors, and it's all managed by, like, professional fund managers.
So it's like having a personal investment team, but without, like, the super high fees.
Exactly. And there are tons of different mutual fund schemes out there catering to different risk levels, investment goals, all sorts of things.
So you can pick one that, like, matches your style.
Right. Like if you're risk averse, there are schemes for that. If you're more aggressive, there are schemes for that too.
Cool. Okay, so we got our four main types of securities, but where do they actually get traded? I know the guide mentions, like, primary and secondary markets.
Yeah, those are the two main segments of the securities market.
Okay, but what's the difference?
Think of the primary market as the birthplace of securities.
Oh, birthplace.
Yeah, it's where companies first issue new shares or bonds to raise capital.
So that's where, like, IPOs happen, those initial public offerings we always hear about.
Exactly. When a company goes public for the first time, that's the primary market.
Okay, so it's like the initial fundraising round.
Exactly. And besides IPOs, companies can issue more shares later on through what they call follow-on public offerings,
Follow on.
or they could do rights issues, bonus issues, even preferential issues to, like, specific investors.
So the primary market is all about companies getting that initial or sometimes additional funding.
You got it.
Okay, so that's where the securities are born. Where do we come in? The everyday investors.
That's where the secondary market takes over.
Yeah.
Once those securities are issued in the primary market, they get listed on stock exchanges.
Ah, okay, like the BSE and NSE here in India.
Right. And then in the secondary market, investors can buy and sell those already issued securities from each other.
So that's where all the action is, all the buying and selling frenzy.
Exactly. The secondary market is all about trading. And it's super important because it provides liquidity.
Liquidity mean.
Meaning, you can easily buy or sell your investments whenever you want, as long as there's someone else willing to trade with you.
Oh, I see. So it's like ensuring there's always a market for your investments.
Precisely.
Okay, so primary market for new issuances, secondary market for the trading. Makes sense? Now, the guide also talks about these market infrastructure institutions.
Yeah, they're the backbone of the whole system.
But, like, what does that even mean?
It means, they make sure everything runs smoothly behind the scenes. They're kind of like the unsung heroes of the market.
Okay, so who are these unsung heroes?
Well, we're talking about stock exchanges, clearing corporations, and depositories. They all play a crucial role.
Okay, let's break those down one by one because I'm already getting lost.
Sure. So stock exchanges, those are the most well-known. They're basically the platforms where buyers and sellers come together to trade securities.
Right, so they're like the marketplace.
Exactly. They help establish fair prices, ensure transparency, make sure the trading process is smooth and orderly.
So it's like an organized auction, but with, like, strict rules in place.
Exactly. And in India, we've got major nationwide exchanges like the BSE, the National Stock Exchange, the Metropolitan Stock Exchange. Those are the big players.
Got it. Okay, so we got the stock exchanges connecting buyers and sellers. What about clearing corporations? What do they do?
Clearing corporations, they're like the guarantors of the market. They step in to make sure trades settle smoothly.
Settle smoothly, meaning?
Meaning the buyer gets their securities and the seller gets their money. They kind of act like a middleman, ensuring both parties uphold their end of the bargain.
So it's like having a trusted third party overseeing the transaction.
Exactly. They eliminate the risk of someone backing out of a deal after the price has changed, which could lead to, like, big losses for the other person.
Oh, that makes sense.
Yeah. They're essential for maintaining trust and stability in the market.
Okay, and lastly, we have the depositories. Those are the ones that hold our securities, right?
You got it. They're all about safekeeping, making sure your investments are held electronically in those DMAT accounts we talked about earlier.
Right, so they're like the custodians of our digital securities.
Precisely. They make the whole process much more efficient and secure than dealing with, like, those old school physical share certificates.
Okay, so less paperwork, less hassle.
Exactly. And in India, the two main depositories are NSDL and CDSL.
Okay, so we got the stock exchanges, the clearing corporations, and the depositories all working together to keep the market humming.
And let's not forget all the other players in the market. We have brokers, merchant bankers, underwriters, analysts, advisors.
Wow, it's a whole ecosystem.
It is. And all of them are regulated by SEBI to ensure fairness and transparency.
Right, got to have those referees keeping everyone in check.
Exactly. Now, I think it's time we address the elephant in the room.
Oh, what's that?
Risk. It's a word that can make some people nervous.
Yeah, risk.
Yeah.
It's kind of unavoidable in any investment, right?
It is inherent in the market, yeah. But understanding risk is crucial for any investor.
Right, because if you don't understand the risks, you can't really make informed decisions.
Exactly. And the guy does a great job of breaking down different types of risks, helping you assess what you're comfortable with.
Okay, so let's talk about those risks. What are some of the main ones we should be aware of?
Well, first, it starts with you. You need to understand your own risk appetite. How much volatility are you comfortable with? Are you looking for steady income, long-term growth, or something in between?
So before even thinking about specific investments, we need to know what kind of roller coaster ride we're willing to take.
Exactly. Now, let's talk about some specific types of risks. Liquidity risk, that's a big one.
Liquidity risk.
Yeah, it refers to how easily you can buy or sell an investment without affecting its price. Like, imagine owning a rare antique. It might be valuable, but finding a buyer quickly at the price you want, that could be tough.
Ah, okay. So liquidity is about how quickly you can convert an investment back into cash.
Exactly. Then you have market risk, sometimes called systematic risk. This is risk that's inherent in the overall market, things that affect everyone.
So like economic downturns.
Exactly. Or political instability, things that impact the whole market, regardless of how good individual companies are doing.
So even if you pick a winning company, those external factors can still influence its stock price.
Absolutely. Now, on the flip side, you have unsystematic risk. This is risk that's specific to a particular company or industry.
Okay, so like if a company makes a bad decision or there's a sudden shift in consumer tastes.
Exactly. Or a natural disaster that affects their operations. Those are all examples of unsystematic risk.
Got it. So that's where research on individual companies becomes really important.
Right. Doing your due diligence is key. And then closely related to that, you have business risk, which is basically the risk that, a company's business model just fails or they face challenges that impact their profitability.
Okay, so it's like evaluating how strong a company's business is, whether their products or services are actually in demand.
Exactly. You want to make sure they have a solid plan for the future.
Yeah, you don't want to invest in a company that's about to go belly up.
Right. And then you have inflation risk, the risk that, rising prices will eat away at the purchasing power of your returns.
Ah, so your money might be growing, but it can't buy as much as it used to.
Exactly. And then there's volatility risk, the one that most people associate with the stock market, the ups and downs.
Yeah, seeing those graphs with the spikes going up and down can be kind of scary.
For sure. But remember, volatility can also create opportunities.
Never true.
And lastly, we have currency risk. This one's more relevant if you're investing in foreign securities.
So even though we're talking about India, global events can still impact our investments.
It's all interconnected, exchange rates fluctuating, things like that. But remember, this isn't meant to scare you away from investing. It's about being aware of the risks so you can make informed decisions and manage those risks effectively.
Right, because the guide also talks about like risk mitigation strategies, right? Ways to kind of protect yourself.
Exactly. Diversification is key. Don't put all your eggs in one basket, Spread your investments across different asset classes, different industries, even different countries if you want.
So it's like the old saying, don't put all your eggs in one basket.
Exactly.
Okay, so we got the rules of the game, we got the players, and we got the hazards. Now let's get to the practical stuff. How do you actually start investing? What are the steps?
Well, it all starts with opening the right accounts. And the guide, lays out the steps pretty clearly. First, you need a bank account, obviously, for managing your funds.
Okay, that makes sense. What else?
Then you need a trading account, sometimes called a broking account, with a stockbroker that's registered with SEBI.
Okay, so the trading account is what lets me actually buy and sell securities.
Exactly. It gives you access to the stock exchanges.
Got it. Now, what about this KYC thing I always hear about?
Ah, KYC. That stands for Know Your Client. It's a mandatory process, basically, for regulatory compliance and investor protection.
Okay, but in plain English, what does that mean?
It means verifying your identity, your address, to prevent fraud, money laundering, all that bad stuff. You'll need to provide documents like your PAN card, Aadhaar card, passport, things like that.
So it's like proving you are who you say you are.
Exactly. And once that's done, you get this unique KYC identification number, or key, BN.
The key. Okay.
And that key ON, it's valid across all intermediaries in the market, so you only got to go through the process once.
Oh, that's good to know. Okay, so we got a bank account, we got a trading account. What's the third essential account?
The DMAT account, short for dematerialized account.
Dematerialized. Okay.
This is where your securities are held electronically, kind of like your digital portfolio.
Ah, so it's like my personal stock certificate library, but online.
Exactly. More secure, more convenient.
Got it. So bank account for funds, trading account for buying and selling, and demat account for holding my investments. Those are the three pillars.
You got it. And the guide even mentions that some institutions offer like 3-in-1 accounts, which combine all three for convenience.
Oh, that's cool. So you can just do it all in one place.
Exactly. Now, regardless of what kind of account you choose, the guide emphasizes some precautions to take.
Okay, what kind of precautions? Give me the lowdown.
Well, first off, always read all documents carefully before you sign anything. Make sure you understand the terms and conditions, the fees, all that fine print.
No blindly signing on the dotted line.
Definitely not. And never, ever sign blank documents. Fill everything in yourself carefully and provide your correct contact info, especially your mobile number and email address.
Right, so you don't miss important updates or communications?
Exactly. And always demand a copy of the account opening form for your records. You never know when you might need it.
Okay, so those are the basics. What about actually investing? The guide talks about investing in the primary market and the secondary market. Okay, so we've got our accounts set up, we're feeling all official, and now we're ready to actually start investing. So the guide gets into specifics about both the primary and secondary markets, right?
Right. Two different ways to approach investing.
Let's start with the primary market. What should investors know about participating in IPOs, those initial public offerings and other new issuances?
Well, the key thing is to really understand the prospectus. That's the company's offer document.
So it's like their pitch to investors.
Yeah, but it's way more than just a sales pitch. It's packed with information about the company's business, their financials, the risks involved, all the terms of the offering.
Okay, so this is where we really need to do our homework.
Absolutely. No skimming or skipping over the fine print here. Take your time, read carefully, and if anything is unclear, don't hesitate to ask questions.
Got it. So let's say we've read the prospectus, we've done our due diligence, and we're ready to invest. What's the next step?
Well, the guide explains the application process, and thankfully, it's gotten much easier and more secure in recent years. They have this system called ASBA.
ASBA.
Yeah, it stands for Application Supported by Blocked Amount. Basically, it streamlines the whole process.
Okay, so how does ASBA work?
It's pretty simple. The money you're using to apply for shares, it gets blocked in your bank account, but it stays there. It doesn't actually leave your account until the shares are allotted.
Oh, I see. So my money isn't actually taken out unless I get the shares.
Exactly. And that blocked amount, it continues to earn interest in your account. If you get allotted the shares, the needed amount gets debited, and the rest is unblocked. And if you don't get any shares, the whole blocked amount is just released back to you.
That's really convenient. No more waiting for refunds or dealing with complicated paperwork.
Exactly. It's so much smoother. And the guide even mentions that you can now use UPI for IPO applications, which makes things even easier.
Wait, UPI for IPOs? That's amazing.
It is. Technology is really changing the game.
Okay, so once the IPO closes, the shares get allotted, and then they're listed on the stock exchanges, which brings us to the secondary market.
Right, where the trading begins.
Okay, so we've covered the primary market, where securities are born. Now let's dive into the secondary market, where all the trading action happens. What should investors know about buying and selling securities on stock exchanges?
Well, the first thing to know is that you can't just Like walk into a stock exchange and start trading. You need a stockbroker.
Right. They act as our intermediary.
Exactly. And the guide highlights that there are different ways you can place orders with your broker. You can use online trading platforms, mobile apps, you can call them up, or even go to their office in person.
So there's an option for everyone, whether you're tech savvy or prefer a more like old school approach.
Exactly. And once you place your order, your broker will execute it on your behalf on the stock exchange.
Okay, makes sense. What else should we know about trading?
Well, for starters, trading only happens on trading days, which are typically weekdays, excluding holidays.
So no weekend trading sprees.
Not on the official exchanges, no. And then there's the settlement cycle. In India, we follow a T+2 rolling settlement system.
T+2. Okay, I'm going to need you to break that down for me.
Sure. T refers to the trading day, and +2 means 2 business days after that trading day. So if you buy shares on a Monday, they'll usually be settled and credited to your DMAT account on Wednesday.
Ah, so there's a little bit of a lag time.
Exactly. And this is where the concepts of pay-in and payout days come in.
Okay, pay in and pay out.
Pay-in day is when brokers have to transfer funds or securities to the clearing corporation, and payout day is when the clearing corporation transfers those funds or securities to the brokers.
So it's like a synchronized dance between the brokers and the clearing corporation to make sure everything settles properly.
Precisely. It's all about ensuring a smooth and efficient settlement process.
Got it. Now, the guide also mentions some essential documents and tools that investors need to be familiar with. What are those?
One of the most important is the contract note.
The contract note.
It's basically your legal proof of the trade you've executed, like a receipt.
Oh, okay, so it details what I bought or sold, the price, the time of the trade, all that stuff.
Exactly. Brokerage charges too, and other important info. Definitely keep those for your records.
Got it. Any other documents I should be aware of?
Well, the guide highlights SMS and email alerts as essential tools.
Oh, yeah, those are super helpful for staying updated.
Exactly. They provide real-time updates on your trading activity and your DMAT account.
It's like having a 247 watch on your investments.
Right. And the guide encourages everyone to register their mobile number and email ID with their broker and DP to receive those alerts.
Okay, will do. What else?
Well, there's also something called running account authorization, which is helpful for frequent traders. It lets them keep funds or securities with the broker for faster settlement.
So it's like a dedicated account for all their trading activities.
Precisely.
Nice.
And the exchanges also offer online trade verification modules, so you can independently verify your trades.
Okay, that's good to know.
And you have the right to receive regular statements of account from your broker and depository.
So it's all about transparency and accountability.
Exactly. And to make things even more convenient, they've got something called a Consolidated Account Statement, or CAS.
CAS, okay.
This combines info from your mutual fund and DMAT accounts, all linked to your PAN card, so it's easier to track all your investments in one place.
Oh, that's super helpful. I like anything that simplifies things.
Me too. Now, before we move on, let's talk about a term that often confuses people. Margin money.
Margin money, yeah, I've heard that term, but never really understood it.
Think of it as a kind of like a good faith deposit that brokers require before they execute your trades.
Okay, like a security deposit.
Exactly. It's meant to cover potential losses if you fail to, fulfill your settlement obligations.
So, like, if I buy shares but then can't pay for them?
Right. And you can provide margin in various forms like cash, securities, or even cash equivalents like fixed deposits. The guide also mentions something called early pay-in, where you can avoid margin requirements by delivering the funds or securities before the pay-in date.
Oh, that's interesting.
Yeah, so if you have the funds readily available, you can bypass that margin requirement.
Cool. Okay, I think I'm starting to get the hang of margin money. Now, what about those derivatives we talked about earlier? Okay, derivatives, I feel like we need a deeper dive on those because they're always a bit of a mystery to me.
Yeah, they can be a little complex. But to recap, they're basically financial instruments that derive their value from some other asset, like a stock, a commodity, whatever.
Right, so their value is like a reflection of something else.
Exactly. And they're mostly used for two things: hedging and speculation.
Okay, hedging and speculation.
Hedging is like buying insurance for your investments. So let's say you're worried about the price of a stock you own going down. You can buy a put option, which gives you the right to sell those shares at a certain price, even if the market price falls below that.
Ah, so it's like protecting yourself from potential losses.
Exactly. Now, speculation, that's a different beast. It's using derivatives to try to profit from price movements, whether they go up or down.
Okay, so it's more about like predicting the market and trying to capitalize on those predictions.
Right. Higher risk, potentially higher rewards, but definitely not for the faint of heart.
Got it. So within derivatives, the guide focuses on the futures and options segment, right?
Right. Futures contracts, those are obligations to buy or sell the underlying asset at a specific price on a future date. Options contracts, those give you the right but not the obligation to buy or sell.
So futures are binding while options are more flexible.
Exactly. But, and this is important, the guide really emphasizes the high-risk nature of derivatives. They specifically advise against them for most retail investors, especially beginners.
So proceed with caution in the derivatives market?
Absolutely. Now let's switch gears and talk about mutual funds.
Ah, yes, mutual funds. We mentioned them earlier, but I think we could use a little more info on those. What are the key things to know?
Well, remember how we talked about pooling your money with other investors to buy a basket of different assets? That's exactly what mutual funds do.
Right, and they're managed by those professional fund managers.
Exactly. So you're essentially getting professional expertise to manage your money.
Sounds good to me.
Yeah.
So is there, like, a mutual fund for every type of investor?
Pretty much. You have funds that focus on stocks, funds that focus on bonds, funds that mix the two. You have funds for different risk levels, different investment goals, you name it.
So it's all about finding the right fit for your needs and your risk tolerance.
Right. And the guide even mentions solution-oriented schemes, which are designed to help investors achieve specific financial goals, like retirement planning or saving for a child's education.
Wow, so there's a lot of variety and flexibility.
There is. Now, the guide also walks you through how to invest in mutual funds. The first step, just like with opening a trading account, is KYC.
Ah, that KYC again. So it's the same process, verifying my identity and all that.
Exactly. Once that's done, you can choose a scheme that suits your needs and fill out an application form.
Okay.
You can gift a lump sum, or you can opt for a systematic investment plan, or SIP.
SIP. Okay. What's that?
This SIP is basically a way to invest regularly, like a fixed amount every month or quarter.
So like an automated savings plan for mutual funds.
Exactly. It's a popular option, especially for long-term goals.
Makes sense. Now, how do we know which mutual funds are riskier than others? I know there's like a rating system or something.
Right. SEBI actually requires mutual funds to be labeled according to their risk levels.
So no more investing blindly.
Nope. They have a tool called the riskometer, which is this visual scale ranging from low risk to very high risk.
Okay, so it's like a quick way to assess the risk level.
Exactly. And that riskometer is evaluated every month. You can find it on the websites of the mutual fund companies and AMFI.
AMFI, that's the Association of Mutual Funds in India, right?
Right. Okay, now the guide also mentions another interesting type of investment. Exchange-traded funds, or ETFs. ETFs, okay, those always sounded kind of confusing to me. Are they like mutual funds?
They are similar to mutual funds in that they hold a basket of assets, providing diversification, but they're also traded on stock exchanges, just like individual stocks.
So you get the benefits of a mutual fund, but with the tradability of a stock.
Exactly. And they usually have lower fees than traditional mutual funds and higher liquidity.
So it's kind of like the best of both worlds.
You could say that. Now, even with all these safeguards and regulations in place, sometimes things can go wrong.
Right, because no system is perfect.
Exactly. And that's why the guide has a whole section on grievance redressal.
Grievance redressal, so like what to do if you have a complaint.
Exactly. What steps you can take if there's a problem, a dispute, something like that.
Okay, so what are those steps? What do they recommend?
Well, first and foremost, they say you should try to resolve the issue directly with the intermediary or company involved. Right, so talk to your broker, your DP, whoever you're dealing with.
Exactly. Communication is key.
Yeah.
Try to sort things out amicably. But if that doesn't work, you can escalate the complaint to the relevant stock exchange or depository.
So like going up the chain of command.
Exactly. And if that still doesn't resolve the issue,
There's a higher authority.
you can file a complaint with SEBI directly through their online platform called SCORES.
Scores. Okay.
It stands for SEBI Complaints Redress System. It's all online, super convenient, and SEBI takes those complaints very seriously.
That's reassuring to know.
Right. It's good to have that safety net. The guide also mentions the investor services cells at the stock exchanges and depositories.
What are those for?
They're there to help investors address queries, resolve complaints, even offer arbitration if there's a dispute that needs settling.
Wow, so they really have a whole system in place to protect investor interests.
They do. Now, one last thing before we move on. The guide talks about unclaimed shares and dividends. It's surprisingly common.
Unclaimed? So, like, people just forget about their investment.
Yeah, it happens. People forget, they change addresses, they have shares in physical form and lose track of them, things like that.
Oh, wow. So what happens to those shares and dividends?
Well, any dividends or shares that remain unclaimed for 7 consecutive years,
7 years? Wow.
they get transferred to the Investor Education and Protection Fund, or IEPF.
Okay, so there's at least a system in place to, like, recover those lost or forgotten investments.
Exactly. And if you think you might have some unclaimed shares or dividends out there,
How do you even check?
the guide provides the website for the IEPS. You can go there and find more info.
Okay, good to know. Now, this guide is really packed with tips and advice, and I know we've only just scratched the surface, but before we go any further, I want to highlight one thing that they really emphasize:
What's that?
being super cautious when dealing with unregistered investment advisors.
Oh, yeah, that's a big one.
Yeah.
Unfortunately, there are people out there who take advantage of unsuspecting investors.
It's like the financial equivalent of a wolf in sheep's clothing.
Exactly. They promise unrealistic returns. They offer advice without the necessary qualifications.
So how do we protect ourselves? How can we tell if an advisor is legit?
The most important thing is to check if they're registered with SEBI. SEBI has a list on their website. You can search by name or registration number.
Okay, so always verify their credentials before trusting them with your money.
Absolutely. And the guide gives some great advice on red flags to watch out for.
Oh, red flags, like what?
Well, one big one is promises of guaranteed or unrealistic returns. Remember, no one can predict the market perfectly.
Right. If it sounds too good to be true, it probably is.
Exactly. Another red flag is if they ask to handle your funds directly, like asking you to give them the money instead of going through proper channels.
Okay, so no handing over cash in a briefcase.
Definitely not. And be wary of anyone who pressures you into making quick decisions, without giving you time to research and think things through.
So it's all about doing our due diligence, taking our time, and not being swayed by, like, high-pressure tactics.
Exactly. Now let's go back to ASBA for a minute.
ASBA, the application supported by blocked amount system.
Right. The guide has a whole section on using UPI with ASBA, which I thought was really interesting.
Wait, UPI for IPOs, we talked about that earlier, but the guide goes into more detail.
It does. It basically lays out the whole process step by step.
Okay, so how does it work?
It's actually pretty simple. First, you fill out your bid details in the application form, and you include your UPI ID.
So it's the same form, just with the option to use UPI.
Exactly. Then the stock exchange sends your bid details, along with your UPI ID, to the escrow bank, which is designated by the company doing the IPO. Then comes the fun part, blocking the funds. The escrow bank sends you a request to authorize blocking the amount you're applying for.
So it's like putting a hold on the money in my account.
Right. But the money stays in your account. It just gets earmarked for the IPO. And you authorize this blocking using your UPI PI.
Okay, and then what?
After the shares are allotted, if you're successful, the funds are automatically debited and any extra funds are unblocked. And if you don't get any shares, the whole amount is released back to your account.
So it's all automated.
Exactly. Super convenient. The guide does mention a few things to keep in mind, though.
Like what?
Well, first, you need to make sure your bank is eligible for UPI-based ASBA transactions. Not all banks offer this yet.
Okay, good to know.
And you also need to use SEBI-authorized mobile apps and UPI handles. And currently, there's a limit of 2 lakhs rupees per UPI transaction.
So there are some safeguards in place?
Right, just to ensure everything's secure and compliant.
Makes sense. Okay, so ASBA with UPI, definitely something to look into.
Yeah, it's a game changer for sure. Now, I want to switch gears a bit and talk about something that really struck me when I was reading this guide.
I'm all ears.
It emphasizes how the securities market really connects those who have money with those who need it. It's like a bridge between savers and borrowers.
Right, because companies need capital to grow and create jobs.
Exactly. And investors provide that capital. So by participating in the market, by understanding how it works, by making smart decisions, you're not just growing your own wealth.
You're contributing to the economy as a whole.
Precisely. You're helping businesses flourish. You're supporting innovation.
It's like this big financial ecosystem.
Exactly. And this guide gives us the tools to be active participants in that ecosystem.
I love that perspective. It definitely makes investing feel more purposeful.
It does. Now, speaking of tools, you mentioned earlier that the guide had a whole section on do's and don'ts for investors.
Oh, yeah. It's like a cheat sheet for navigating the market safely and avoiding those classic mistakes.
Okay, so give us the rundown. What are some of the big do's?
Well, one of the most important is to invest for the long term. Avoid getting caught up in those short-term market swings and focus on your long-term goals.
Right, because the market will always have ups and downs.
Exactly. Slow and steady wins the race. They also stress the importance of doing your research and understanding your risk tolerance before jumping into anything.
Definitely. You need to know what you're comfortable with and what you're investing in.
And another big one is diversification. Don't put all your eggs in one basket. Spread your investments across different asset classes, different industries, the whole 9 yards.
That's classic advice, but it's so true.
It is. Now, what about the don'ts? What should we avoid?
Well, we've already talked about this, but it bears repeating.
Hmm.
Don't deal with unregistered investment advisors. Always verify their credentials before trusting them with your hard-earned money.
Right. No shady dealing.
Exactly. And another big don't is investing based on emotions. Fear and greed, those can really cloud your judgment.
Yeah, it's easy to get caught up in the hype, especially when everyone around you seems to be making money.
It is. But you got to stay level-headed, stick to your plan, and make decisions based on logic and research, not on your gut feeling.
Right. So do your research, diversify, think long term, and keep your emotions in check. Those are some great takeaways.
They are. Now, the guide also has a section on the rights and obligations of investors, which I think is really important.
Oh, yeah. What does it say about that?
Well, it basically outlines the rights you have as an investor and the responsibilities that come with those rights. For example, you have the right to receive timely and accurate information about your investments. You're entitled to regular statements of account, contract notes for all your transactions.
Okay, so transparency is key.
Exactly. You also have the right to a fair and transparent grievance redressal mechanism. If you have a complaint, you have the right to seek resolution and escalate the issue if needed.
So it's not just about trusting the system blindly. You have recourse if something goes wrong.
Precisely. Now, on the flip side, you also have responsibilities as an investor.
Like what?
Well, you have the responsibility to provide accurate and complete information when opening accounts, when making transactions.
So no trying to be sneaky or game the system.
Exactly. And you're also responsible for understanding the risks involved in different investments and making informed decisions based on your own financial goals and your risk tolerance.
It's like a two-way street. Investors have rights, but they also have a responsibility to act ethically and diligently.
Exactly. Now, before we move on, I wanted to circle back to something you mentioned earlier, SEBI's focus on investor education.
Oh, yeah, they're really putting a lot of emphasis on that.
They are. This guide itself is a testament to that commitment. But they also have other initiatives like financial literacy programs, investor awareness workshops, regional seminars.
So they're really trying to reach a wide audience.
They are. And they're also collaborating with investor associations and other organizations to make those resources more accessible.
It's like they're trying to build a culture of informed investing in India.
Exactly. And they encourage investors to take advantage of these resources. The guide even provides contact info for SEBI, the stock exchanges, depositories, other organizations where you can find more information and guidance.
So there's really no excuse for being uninformed.
Right. Now, did you notice that the guide also has a glossary at the end?
I did. I thought that was a great addition, especially for people who might be new to all the financial jargon.
It's super helpful. It breaks down all those complex terms and acronyms in simple language.
Definitely a valuable resource for anyone navigating the market. Earlier you mentioned how investing is about more than just personal gain, how it's about contributing to the larger economy.
Right. It's about that connection between savers and borrowers, fueling economic growth.
Exactly. And this guide really highlights that connection. It explains how the market channels funds from those who have surplus capital to those who need it, and how that process drives economic development.
It's like a virtuous cycle. Investors provide capital, businesses grow, the economy expands, and everyone benefits.
I love that. It makes investing feel like you're part of something bigger.
It does. Now, I know we've covered a lot of ground today, but is there anything else in this guide that you think our listeners should be aware of?
Well, one thing that stood out to me was the emphasis on the importance of financial planning. The guide really stresses that investing should be a part of a comprehensive financial plan, not just a standalone activity.
Right. It's not just about picking stocks and hoping for the best.
Exactly. You got to think about your income, your expenses, your risk tolerance, your time horizon, all those factors.
So it's like building a house. You need a strong foundation and a well-thought-out design.
Precisely. And the guide even provides some basic guidelines for asset allocation, suggesting how much you might want to allocate to different asset classes based on your risk profile.
That's really helpful, especially
Yep.
for beginners who might be feeling overwhelmed.
It is, and I think that's one of the most valuable things about this guide. It empowers investors with knowledge. It encourages them to take control of their financial future. Right. It's not about relying on someone else to tell you what to do with your money. It's about understanding the market, making your own informed decisions.
Exactly. And with the knowledge we've gained from this guide, I think we're all better equipped to do just that.
This has been such a great deep dive. I feel like I've learned so much about the Indian securities market and how to navigate it effectively. What are some of the key takeaways that you think our listeners should walk away with?
Well, I think the biggest takeaway is that investing in the securities market is not as intimidating as it might seem.
Right. It can seem really complicated at first.
It can. But with the right knowledge, with the right tools, and with a little bit of guidance, anyone can participate and benefit from the growth opportunities that the market offers.
So it's about demystifying the world of investing, making it accessible to everyone.
Exactly. And another key takeaway is the importance of being a responsible, informed investor.
So doing your research, understanding the risks, making decisions that are right for you.
Precisely. And remember, there are resources available to help you along the way. SEBI, the stock exchanges, they're all committed to investor education and empowerment. So take advantage of the information and guidance they provide.
Great advice. Now, before we move on to our final thoughts, I want to touch on one more thing. The ethical side of investing.
Ah, yes. Ethical considerations.
Yeah.
The guide doesn't go into too much detail on that, but it's definitely something we should all be thinking about.
Right. It's not just about making money, it's about making money responsibly.
Exactly. And there's a growing movement toward what they call ESG investing.
ESG.
Yeah, it stands for environmental, social, and governance factors.
Okay, so it's about investing in companies that are not just profitable, but also sustainable and ethical.
Precisely. For example, you might avoid companies with a bad environmental record, or companies that engage in unethical labor practices.
So it's about aligning your investments with your personal values and maybe even contributing to a better world in the process.
Exactly. And there are actually quite a few mutual funds and ETFs now that focus specifically on ESG investing.
Oh, wow. That's really cool.
It is. It's making it easier for people to incorporate these ethical considerations into their portfolios.
I love that. Okay, so we've covered a lot in this second part. Can we do a quick recap of the key takeaways?
Absolutely. We talked about the importance of investor education, understanding your risk tolerance, diversifying your investments, being wary of unregistered advisors.
We also talked about the mechanics of trading, the different types of accounts you need, all those important documents and tools.
And we touched on the ethical considerations of investing and how you can align your investments with your personal values.
This has been such an insightful journey. I feel like we've really explored every nook and cranny of the Indian securities market.
We have. And I hope our listeners feel empowered and informed.
Absolutely. But before we wrap up this episode, I have one last question for you.
Okay, shoot.
If someone is completely new to investing, what's the one piece of advice you would give them?
That's a good one. I think I would tell them to start small and learn as you go. Don't feel like you need to invest a huge amount of money right away.
So dip your toes in the water first and then gradually build your confidence and knowledge?
Exactly. Start with an amount you're comfortable with, even if it's just a few hundred rupees. Learn the basics, get familiar with the process, and then increase your investment as you gain more experience.
That's great advice. Okay, so start small, learn as you go, and don't be afraid to ask for help.
Exactly.
This has been a fantastic deep dive. I feel like we've covered everything from A to Z.
We have. And I hope our listeners feel the same way.
Absolutely. A huge thank you to our expert for sharing your expertise and guiding us through all the ins and outs of the Indian securities market.
It's been my pleasure.
Well,
Always happy to help demystify the world of finance.
and to our listeners, we hope you found this deep dive valuable and empowering. Remember, knowledge is power, especially when it comes to investing. So stay curious, stay informed, and keep exploring the world of finance.
And never stop learning.
Great advice. That's it for this episode of The Deep Dive. Until next time, happy investing.
It's a really great point. Investing really is about building that secure future. And I feel like this guide just gives you like the blueprint to do it right.
It does. And what's cool is that it also reminds you that the market's always changing, right? There are new products, new technologies popping up all the time, like that UPI integration with ASBA.
Oh, yeah. Who'd have thought you could apply for IPOs using UPI? That's insane.
It's a game changer, especially in terms of making investing more accessible.
Totally. And so as the market changes, it's even more important to stay informed, to adapt your strategies.
Absolutely. You can't just rely on what you knew like 5 years ago.
Exactly. Things move so fast.
They do. And that's why this investor education piece is so crucial. And I think SEBI, the stock exchanges, they're doing a phenomenal job with that.
They really are. All the resources they provide, it's impressive.
It is. It really shows their commitment to helping investors succeed. I totally agree. Now, before we wrap up this whole deep dive, I want to touch on one more thing that I think is super important, and it's something the guide doesn't really address directly.
What's that?
The emotional side of investing.
Ah, yes. The psychology of it all.
Right. Because we can talk about all the technical stuff, the analysis, but we all know that fear and greed can really mess with our heads when it comes to money.
Oh, absolutely. When the market's soaring, everyone's making money, it's so easy to get caught up in that euphoria.
And then you start making like impulsive decisions, buying things you don't even understand.
Right. You just want to get on that bandwagon before it's too late. And then, on the flip side, when the market takes a nosedive,
Panic sets in.
everyone's selling, and you just want to get out before you lose everything.
So how do we control those emotions? How do we avoid making those irrational decisions?
I think the key is to have a solid investment plan, a strategy that you stick to no matter what the market's doing.
So it's about having that long-term vision, not getting distracted by the daily ups and downs.
Exactly. Your plan should be based on your financial goals, your risk tolerance, your time horizon. And once you have that plan, resist the urge to deviate from it just because you're feeling, greedy or scared.
That's such good advice. It's like having a roadmap to guide you through the market's jungle.
Exactly. And, if you're ever feeling unsure or overwhelmed, don't be afraid to reach out to a financial advisor.
Right. Get that professional guidance.
They can help you develop a plan, and they can also provide that objective perspective when you're feeling those emotional pressures.
Okay, so have a plan, stick to it, and don't be afraid to ask for help.
Got it. This has been such an incredible deep dive. We've really explored every aspect of the Indian securities market.
We have, from the regulatory landscape to the different types of securities, risk management, all those practical tips and advice.
We talked about investor education, the importance of ethical investing, even the psychological side of it all.
It's been quite a journey. It really has. And to all our listeners out there, remember, the world of investing is always changing, so never stop learning, stay curious, and always, always seek knowledge. And most importantly, invest wisely. Make sure you understand what you're doing.
Well said.
That's all for this episode of The Deep Dive. Until next time, happy investing.